Treasury yields have seen their widest range in August. You got to go all the way back to November of 2016, the month that President Trump was elected. We saw a massive shift higher in yields, and only this month have we seen as wide a range, although yields are going the other way. And look, it's only the 9th, so we still have plenty of time to maybe exaggerate that move even more, making it the widest range since actually going back to 2015. So right now, the market seems very much being pushed on wider swings. Yes, we put in that low of 159 in the 10-year note yield, but we pushed off it a little bit to end the week a little bit off there around 172, 173. So while we are seeing yields creep higher, they're certainly still very, very low and will remain so at least for the time being. And I look at the range being just a kind of an indicator that volatility is going to be wider, and there are going to be bigger, exaggerated knee-jerk reactions to whether it's trade, whether it's the data, the Fed, you name it. The market seems very much here willing to move much further than it would normally to these ranges. And I think that right now the keys are going to be about, can the Fed get control of the market? Will the trade talks resolve themselves? And can the economic data support what the Fed has hoped all along? Let's not forget, hope can be a very bad hedge. So right now we are kind of off those low yields that we posted midweek, but still very low. And if you look at volatility, yes, I mentioned it was higher, and it should be. We broke out of the range. We saw things kind of get a little chaotic in the markets, with the equity markets getting sold off, with the bond market yields seeing them plummeting. Yes, we got to the highest level of yields we've seen since 2017. So we kind of leapfrogged all those highs, modest highs we saw in 2018, went right to 2017, and as well we should have. The market seems very confused here, and expectations now are all over the map. So if you get a range that's set, like perhaps if we had maybe between 170 and 190, or we look at maybe something like 190 and 215, where we had a set range, we kind of had well-defined areas where volatility should move higher if we break outside of those ranges. But we've seen such big movements in the underlying that at this point, new lows will bring higher volatilities. And if we creep back higher, as we did at the end of this week, volatility should come off. So while volatility did hit new almost 2-year highs midweek, we did come off those highs heading into the weekend, which should be expected. So what do we have next week, which could possibly continue or maybe bring some calm to the market? Well, we have data coming out. Yeah, inflation and retail sales and some housing numbers. But I think that's all going to be overlooked, because the following week we get July FOMC minutes, we get the Jackson Hole Symposium, and we get a G7 meeting. So there's a lot of bigger, more macro events coming on the way. I think at this point, yes, the data we get from the BLS and others will give us maybe an hour's worth of trade. But I think the bigger picture has to looking out a week after that. So the bond market may get a little relief from the big moves that we've seen, unless there is more talk of trade, unless there is more negative talk from the Fed, unless something out of left field that we haven't priced in comes into the market, if you can believe that. So at this point right now, watch out for a calm market, because those are the ones that tend to be overlooked when you have big news coming down the road. So right now the market off those big yield moves we saw midweek, but certainly still low, and certainly still able to push to even lower yields if something comes across the radar that the market isn't looking for.